Your home insurance jumped 31% in the last 5 years, even if you never once filed a claim. That's more than double Canada's 15% inflation over the same stretch. And nobody sent you a letter explaining why your risk suddenly got more expensive. I read the fine print so you don't have to. Millions of Canadian homeowners are quietly paying more for the exact same coverage, and it's costing a typical Ottawa homeowner tens of thousands over a working life. Today I'll show you 3 moves. Audit your curve, shop your risk, and cut your risk score. Here's the number that should make you angry: 31%. That's how much home and mortgage insurance costs rose from 2021 to 2025, according to Statistics Canada's Consumer Price Index, against only 15% overall inflation. But here's the part nobody tells you. That gap has nothing to do with whether you ever claimed. 3 moves fix this. Audit your inflation versus premium curve, shop your risk instead of your address, and cut your aging home risk score. Each under 30 minutes, all free. Canadian home insurance has slipped into what the industry calls a hard market, where insurers raise premiums well above inflation to offset climate losses, reinsurance costs, and higher rebuild prices. The Insurance Institute of Canada reported home and auto rates hardened, were at 10.9% year over year in the first quarter of 2024. That increase is priced at the portfolio level, not based on anything you personally did. Before 2020, annual increases hovered near general inflation, roughly 2 to 3% a year according to historical CPI patterns. Now, increases of 5 to 11% a year are normal. On a $1,200 policy from 2021, a 31% rise by 2024 means about $1,572. An extra $372 a year, Statistics Canada CPI 2021-2025, with no change to your coverage or claims history. The second layer is harsher. Insurers aren't just charging more, they're redefining what counts as high risk. Analysts told Yahoo Finance that insurers are widening exclusions, raising deductibles, and pulling back from disaster-prone regions. Extreme weather plus aging housing stock means your home can get reclassified upward, without you touching a thing. And the cost of doing nothing compounds. In Alberta, homeowners now pay about $660 more per year than in 2015. A 66% rise according to MyChoice's 10-year comparison. Over a decade, that's $6,600 paid purely to reprice risk, not for one extra feature or a single claim. The myth: if I never claimed, my premium should only rise with normal inflation. The fact: Statistics Canada shows costs rose 31% from 2021 to 2025, more than double the 15% inflation, because insurers reprice portfolio-level risk after record catastrophe losses, not your personal claim history. Put the 2 forces side by side. Problem 1 adds about $372 a year on a $1,200 policy, Statistics Canada CPI. Problem 2, a record $9.4 billion in insured losses in 2024, Insurance Bureau of Canada, keeps pushing your base rate higher, even for a spotless claim-free home. Meet Sarah, 42, a public school teacher in Ottawa earning about $85,000 a year. She owns a 1958 detached home and pays $1,800 a year in home insurance, renewed without much thought. Here's what Sarah found when she finally read her renewal letters. Discovery 1, $425 a year. Sarah's premium climbed from $1,375 in 2021 to $1,800 in 2025, a 31% jump matching the national CPI, Statistics Canada. Had it merely tracked the 15% overall inflation, she'd be paying about $1,581, roughly $219 less every single year. Discovery 2, 14.3%. MyChoice found Ottawa premiums rose 14.3%, with 20% of homes built before 1960. MyChoice 2024. In newer stock Vancouver, premiums rose only 9.94%, meaning Sarah effectively pays an old house penalty just for where she lives, not for anything she did. This is general information, right? Not personal advice, and those figures are illustrative. Discovery 3 is the one that stops her cold, $660. Alberta homeowners now pay that much more per year than in 2015, up 56% in 5 years and nearly 400% over 2 decades. MyChoice 2025, Statistics Canada. If Ottawa follows even half that path, Sarah's $1,800 premium could balloon toward $5,000. Across her 23 remaining working years, the risk repricing path costs Sarah about $80,000 in premiums versus roughly $56,500 on a competitive path. The difference, around $25,000. Author's estimate from Statistics Canada, IBC, and MyChoice data is paid purely for repricing, not $1 of extra protection. So could this be you? You've never compared your premiums rise to the actual CPI. You don't know how your city's increase stacks up. And you haven't shopped your policy in over 2 years. If any of those ring true, the next 3 moves are built for you. These 3 moves matter because they're the only levers you actually control. Insurers won't hand back the repricing, but you can force the conversation. Audit your curve, shop your risk, and cut your risk score, and you can realistically claw back 1 or 2 full years of increases while keeping equal or better coverage. Move 1, and I'm leading with this because it's the fastest win. Shop your risk, not your address. Enter your home's year built, coverage limits, and deductible into a Canadian comparison tool. Then request multiple quotes and specifically test higher deductibles and bundled home and auto policies, both of which can cut your cost. Here's how. Enter your address, home year built, coverage, and deductible into the platform. Request quotes from several insurers and test a higher deductible plus bundling. Compare each to your renewal. What good looks like is a quote 10 to 15% below for the same coverage. Move 2. Audit your inflation versus premium curve. Pull your last 5 renewal letters, note the annual premium for each year, then open the Statistics Canada Consumer Price Index for home and mortgage insurance. Compare your personal increase to the 31% national benchmark. If yours is higher, you have real grounds to challenge it. Here's how. Log into your insurer's portal and list 5 years of premiums. Then find the Statistics Canada home insurance CPI change over that same period. Calculate your own percentage rise. Good looks like a personal increase sitting at or below that 31% benchmark. Before I get to the last move, which is the most counterintuitive part of all this one flips the whole game. Instead of just accepting the price, you lower the risk behind it. Move 3 is cutting your aging home risk score by targeting the exact repairs insurers care about: old plumbing, knob and tube wiring, roof age. The things that quietly bump you into the highest risk bucket. Here's how. Check if your home is pre-1960 and note the wiring, plumbing, and roof condition. Ask your insurer which upgrades: poly B replacement, a backwater valve, rewiring. Qualify for a discount, complete one under $3,000, then request a re-rating. If breakdowns like this are useful, subscribe. The next one's already coming. Why now? In 2023, net underwriting losses forced insurers to reprice aggressively. In 2024, a record $9.4 billion in insured catastrophe losses hit, and rates hardened, 10.9% year over year in the first quarter, Insurance Institute of Canada. By 2025, rates were up, 5.28% year to date, MyChoice, already beating inflation, and 2026 estimates point to another 7 to 12%. After you act, verify it worked. You should see your personal increase sitting at or below the 31% CPI benchmark. Confirm at least one quote beats your renewal by 10% or more. And if you completed an upgrade, your insurer should re-rate your risk and lower your premium. Everything here comes from Statistics Canada, the Insurance Bureau of Canada, MyChoice Financial and Industry Reporting. I've linked all of the sources below so you can check the numbers for your own province and city. So now you know how to audit, shop, and cut your home insurance repricing before your next renewal. Next, I'm covering how insurers quietly shrink what your policy actually pays out, without ever touching your premium. That coverage shrink trick is one of the sneakiest moves in the whole industry, and most homeowners never notice until they claim. If you want to catch that breakdown, subscribe now so you don't miss it.